All right, let's kick off. Ladies and gentlemen, good evening. This is Frank Clueless 8 Trading. It's February 9th, 2016, and this is a free market update webinar getting us set up for the Fed meeting tomorrow and the rest of the week, going into next week, obviously. This session is being recorded and will be uploaded on the Clueless 8 YouTube site. So anyone who's new, please go to the YouTube and this Clueless 8 YouTube site and just put in your name as a free subscriber so you get notified anytime that I put anything up there. Full disclosure, this is purely for financial education and not for any solicitation or advice, for obviously. All right, so let's kick off here. Everyone can see the screen. And in the back you see the guts of the market, and that's obviously the S&P futures right now. Somebody else joined here from their cell phone. Not sure who it is. Can you hear us? Okay, doesn't matter. All right, whoever, I'm hearing a little feedback on my voice, so please mute your microphone. I'm not sure who it is. Okay, that sounds it still seems to be on. Maybe it's the person coming off their cell phone. Anyway, I sound like a robot with my feedback coming in. I have somebody by the name of Sue who just joined. Can you identify yourself? Okay. Please identify yourself, Sue. Oh, it's Susie. Okay, that's fine. I saw your email. Please, somebody needs to mute their microphone because it is bouncing back and it's a little bit disruptive. Okay, that's better. I think they did. Okay, let's start off. Couple of in the background, you can see, like I said, the guts of the market, the real deal that happens behind backstage, which dominates everything we do on the external side, right? All right. Let me just a couple of observations. This is one heck of an exhausting market. I have seldom worked so hard to produce content and to guide people like I do, and to keep myself in some form of sanity. Believe me, this is volatility at its extreme. However, it is structured volatility, as you can clearly see, and I've been noticing, and this is one piece of great news for our service, that people seem to be actually looking and glancing at every tactical chart that I'm putting out there, including my comments, breaking news analysis. I've been so busy, I haven't had a chance to do the Periscope broadcast, which I'll start doing tomorrow. Um, and that's good news. The number of engagement and clicks on the Twitter feed is rising exponentially, and that's a great sign. It seems like people are looking at some charts repeatedly, because in some cases we have had 500 clicks, and I don't have 500 members yet, right? So that's it. That's a great thing. Number two, there is a fundamental difference between what can happen 5 days from now and what's happening 15 minutes, an hour, or 2 hours in front of us. I think we all know that, especially active traders that many of you are, okay, working with me here on a real-time basis, know very well. There is a swing perspective on the markets, as we can see from the daily charts, and then there is a 15-minute, 30-minute, 1 hour perspective, which is quite different. The Twitter feed, that the back and forth in the market within a very tight, not that tight, but still within 100-point trading range, let's say, with the S&P 500 between let's say 1825 and 1850, might seem very minuscule when you're looking at the daily picture, but makes a fundamental difference when you're actively trading on your P&L on a daily intraday basis. I think we can all attest to that. So the perspective that we keep on certain trades that we decide to stick to is very different than trades we want to flip during the day and make money. And that's something that has to be ingrained in everyone's head, because as human beings, we like to think that we got into a trade and we're going to stick with it. But the algos and the high frequency trading programs, as we all know, do not allow us sometimes to stick with our conviction. And I think we see that repeatedly on an intraday basis, whether or not we're down 200 points or whether we rally back up 50 points or 100 points and then give everything back. So that's where the volatility comes in. Now, how you manage that and how you can cope with it, that's something you got to do on your own. Okay, I provide all the tools. I provide some very precision charts on the markets. And if you notice lately, I haven't been really recommending a lot of individual stocks because the typical ones that we play for the 5, 10, 15 point type of gainers, you can easily play them by looking at my S&P, my ES or the E-minis that we use as a proxy, and the SPY charts that I put out there. You can very well trade those same things for 5, 10 points, depending on the levels we're hitting or not hitting. And everything is out there on the Twitter feed. And like I said, I'm very happy to see that the level and of engagement as in people looking at those charts has gone up tremendously, which is fantastic. Because it's not really that fantastic for me. It's up to you guys, but it's great for you guys because you can actually see where the road is leading, even on a short-term basis. Where we eventually land up, I think I've made myself very clear on that. Whether or not I'm right or wrong, we'll see. Second point, which is very important. You all know very well that I've had a very powerful bullish bias for a long time. That served me well. But we all have to adapt to the realities on the ground. Now, realities on the ground doesn't mean that all of a sudden I'm some sort of nasty dogmatic bear that thinks the world is going to hell in a handbasket. But I do believe that fundamentally and technically, certain things have changed. And we can see that in the price action of many stocks that we trade, which are beyond normal. I'm not going to say they're abnormal, but I think what's happening with the market is adjusting to a new reality in the market, in the fundamental landscape that calls for a recalibration of valuation. You don't see stocks down 30, 40, 50% on an earnings miss. We saw that multiple times. We're seeing that tonight in the form of Solar City. I hate myself because of my busy schedule for not putting up the trade on that, because technically speaking, I never liked Solar City. Not like for any personal reason, but missed that. But it happens. But I'm going to swing back to the earnings part. The ER plays and stuff. Good, bad, and ugly. Starting tomorrow. Anyway, saying all that, as I was saying, so my bullish bias overall is now contained, in the sense that I don't think the market is going, is going to have another, 1,000-point drop immediately. But I do believe that certain tactical levels have to be met before the market can have a reasonable trading bottom. I'm sorry, a tradable bottom. And one part of the book of my trading book is solidly committed to sticking to my conviction for real reasons, for technical reasons, as well as fundamental reasons, that we are going to retest what we see in front of us. And I'm going to go through all that in a few minutes. in the zone of 1860 to 1760 to 1800 on the S&P 500, and I think that's going to happen. Let me talk about now. Given that backdrop, I do have to admit that there are a lot of mixed signals on the hourly and the 4-hour charts, and things which are not necessarily the longer term daily or weekly charts that are clearly deeply oversold. Technically, they are ready for a bounce. We see that happen quite often in the market intraday. Saying all that, keep in mind, right when you think it's going to be a breakout, you got to watch those levels that I keep on posting, because that's exactly where they come and sell. And my job, which I think I'm doing very well for all of you, is to point out those levels where they come in, where the machines come in, where the algos come in, or whatever it is, the robots come in and they sell. And right there, the retail trader starts getting excited. You all are fortunate enough that you contain your excitement, because you are, in many ways, tracking the charts that I'm putting out there. Just because the market reverses in the last half an hour or the last hour and goes from down, let's say, 100 points to being up 50 points means nothing these days. This is not your old-fashioned grandpa's market. All the legacy technical traders who just think that, oh, if we break this line and that line, we're going to keep on going higher, or we're going to keep on falling lower. It doesn't work like that anymore. I don't need to prove that. You see it happen over and over and over again, because the machines are following a level of technical inflection points which are dominated by oversold and overbought conditions, period. That's all it is. It's not magic that I can pinpoint, give or take, within 5 S&P points where the market's going to turn up or down. So, because I'm using multiple platforms, Thinkorswim, the bar charts, the algo HFT charts as I call them, that's run by Quad. Many of you are users of Quad right now, and you can start to, and you've been noticing, and I'm sure getting used to, it takes a few months to sort of train your eye to look at things, of where those exact inflection points are. Somebody like Richard, who's listening to me for the first time, and Richard, feel free to listen to my previous video cast whenever you have time. You're gonna know that I'm a pure tactical trader. Not to say that I don't know about fundamentals or about macroeconomics and finance and stuff. That's my passion. I'm constantly analyzing the backdrop, all the monetary stuff, all the Fed stuff that's coming out, the sentiment in the market, and then mixing it in with my charts and moving with it. It's a instant analysis, real-time analysis in my head that I'm processing and delivering to all of you. I don't think any service does it to an extent that I do. I don't think there's any service out there that constantly educates and analyzes and explains to people on a real-time basis what is going on. This is truly an education. It's not just a scalping service telling you to buy Netflix down 3 points and selling it up 2 points. Honestly speaking, I think anybody can do that. If they're watching the screen, they see the reversal candle, boom, okay, buy it, sell it. I mean, come on. But the overall picture that I'm delivering as part of my service is, in my opinion, and saying with all humility, I think rather unique. It takes a lot of mental brain power on my part to constantly do that, but that's okay. The other thing that you got to keep in mind, that looking at a chart itself to an untrained eye really means nothing. And even for a trained eye, looking at a chart, this being the S&P 500 daily chart, for example, just looking at the charts without, let's say I hide all the drawings. Yeah, you can see, and you can see the pattern and all that stuff. But but when I transpose my feelings over it in the form of the different patterns, that's when the picture comes alive, and that's when I can act on what I think might happen, because predictions and forecasting and trying to stay one step ahead of what's going to happen is not an easy task. But I'm doing it every single day. And that is something that you all have to pick up and run with. Because when you are one step ahead or even half a step ahead of what the market's going to do, you're going to make very decent money. Don't need to stay with it all the way through, because that depends on your risk tolerance, that depends on the speed of how things are moving, that depends on your risk capital that you're trading with on that market, on that particular trade, or within the market on a certain day. But sorry about that. I lost my train of thought there for a second. Okay. So when I transpose my drawings on it, that's when things start to make sense. Now, many of you have worked with me closely on the group advanced coaching sessions, single sessions, and things like that. And those people, I believe, have a far superior understanding on how to read everything that I do on the charts, because they are truly, the chart is truly talking to them. The market doesn't always have to cooperate, but the chart is talking to them. And then they can manage their trades heck of a lot better than most people out there who are just simply looking at price and the external picture in the market, which is prices moving up and down. Just because price is moving up, to me, in this type of market, is really a sell signal. Prices being down to a certain tactical levels is actually a buy signal. So just by chasing, yeah, you can catch a little bit on the chase, but you don't really make the real money. And that's a fact. All right. So let's get into it right now. The most important part on the observation side is patterns are changing very rapidly. So what we're going to try to attempt to do tonight is to, as I've done before in my previous video cast, is we're going to attempt to nail down certain points where the market, extreme levels that the market can get to, and then the middle ground where the market is trading at. So you all have a pretty good understanding what the roadmap is. Because structured volatility means you have to know where the market can go or not go, both on the long and the short side. And then you can basically adapt to the situation in the middle. Saying all that, we have the big Yellen testimony tomorrow. There are different cross currents that are in play. And regardless of anything, you got to keep in mind that she will try not to say anything that's going to really damage the market, obviously. We're pretty close to a deep extreme oversold condition where a sizable bounce is going to take place. There have been quite a few sizable bounces, to be honest with you, even on an intraday basis. We know that. When you get 200 to 300 points from top to bottom or bottom to top on an intraday basis, those are sizable bounces. 40 S&P points intraday is a pretty sizable bounce. So if somebody who's new here, like Richard, I'm sure you've been trading and you know this probably better than I do, is the market's not a linear being. Don't expect a one-way slide up or a one-way slide down. So just keep that in mind here. The other important thing to keep in mind, that Valentine's Day is this weekend, Sunday. And generally speaking, we got two things going on here. The market generally doesn't crash, just so you know, prior to a major shopping weekend like Valentine's Day. So if somebody's expecting 1,000 point, 500, point drop from where we are all the way down, well, it's probably going to happen rather quickly if it does. But I don't think there's going to be any really sizable crash on Valentine's Day weekend. But what contradicts that is that we're coming in the middle of the month, which is 15th. Now, people who work with me for many months, or even some of you who have been with us for new members, middle of the month, the 15th, give or take a couple of days, is where the market makes a bottom for the month, and then it makes a big run, and then depending on what it wants to do, it either sells off by the end of the month or rises. But generally speaking, the most volatile part of the month is always around the middle of the month. Now, the middle of the month on a calendar basis is the 15th of February, which is Monday. So give or take a couple of days, if you do a plus minus 2-3 days, we're coming into the next couple of days, going into, let's say, the 16th or the 17th. So just let's keep that in mind. I've seen that happen repeatedly, and many of you know that very well, that that's the case. All right, so here's the other very important point. I'm just trying to rehash in my head here. I don't read off scripts, so I'm just trying to get my mental notes out of my head. The other thing is about this news, which, by the way, is not necessarily new news. The Fed had instructed through their notices to the member banks that they will be conducting stress tests, like the Fed does quite often, but this time on negative rates. Guys, let me just tell you this. The United States of America is not ready for negative rates. Somebody said, well, Japan did that, then they rallied and said, well, that's Japan. Look, I love sushi, but I don't live in Japan, okay? So the point is that if you really think about it, you walk out on the street and you tell somebody, oh, by the way, you didn't think about instead of the bank paying you interest, you'll either make no money or they'll have to charge you to keep money in the bank. I'm sure it's not for everybody, but people with some sizable deposits. You think that guy's going to be happy? What do you think? He's going to run out there and buy Netflix? No. Businesses don't like that. U.S. business is very well capitalized. They don't need extra amounts of cash and debt. Some sectors do. Like the oil and shale gas industry, they borrowed big time. That's a different story. But if the technology companies and the other companies out there, they're not out there just borrowing. There's a lot of spare cash out there. So, as in capital investments and capital expenditure by large U.S. corporations, they don't need to have, excuse my French, frigging negative rates. If the Fed thinks that I personally don't think that's ever going to happen in the U.S., because that's going to set a precedent that is going to be horrendous, in my opinion. I've said this for almost 2 years now. It's called the law of diminishing returns, and this is macroeconomic stuff. That QE at one point has absolutely no benefit. In fact, has detrimental benefits because it is a law of diminishing returns. Initially, when they did it, people screamed and shouted, oh my God, it's the worst thing they did. No, in my opinion, it was the right thing to do. And it helped. But when you continue with that, and if you're thinking of reducing rates down to zero for average consumer, not just the Fed funds, and they have to pay kind of, sort of in the simplistic manner, if the bank will not pay you any interest, I don't think that goes down too well. All right, so just keep that in mind. And if she's grilled on that tomorrow, expect some real volatility in the market. Expect some volatility anyway. It's a congressional testimony, and they're not going to let her off easy. Okay, so but then she fights well, so don't expect her to give in either. All right, good. Now let's get into the technicals here. First, let's take a look at the S&P 500 here. And I'm going to try to keep it as simple as possible. This is a daily chart. There's a couple of things going on here, which does not show up on the E-minis, on the futures. This is the actual S&P chart, right? So, okay. So look at this pattern here that you're looking at, and I'm going to zoom in. This was the crash of, just to remind everyone, obviously no. This was the flash crash, August 24th. You got a nice, beautiful double bottom here on September 29th. Now remember, that was a month later. And believe me, that month was a volatile month. Looking back, it's all a pattern, right? In 2020, in hindsight, and everything is easy to read. But while it was going on, it wasn't, and we still navigated that reasonably well, actually very well. And then we had this monstrous move up, right? In my opinion, unless something dramatically changes on the financial front, meaning that the European banks and Deutsche Bank lost huge value. I think they've lost 50% of their value just this year alone, or over the last 12 months. That's huge. It's like saying JP Morgan lost half their value. That's Deutsche Bank. Germany's largest bank is one of the world's largest banks out there. So you got a lot of credit contagion that's taking place right now. And that's that worries me, because when the credit spreads, or the credit default risk, which is basically insurance you buy against major defaults on corporate bonds and on banks, then that's something very worrisome. So saying all that, you can clearly see. So this is what happened, right? And then we kept on moving on sideways, big volatility, and then we gave in. There is a pretty exact pattern symmetry to a certain degree. You got a you have a rising wedge. You can see that rising wedges broke down to a reasonable point, and then you move sideways, tried to hold this level, and then you gave in. This is a falling wedge. What happens to falling wedges? They break out. That's exactly what happened. I called that. If you listen to my video cast from about a month ago, back in January, I said that 1940 to 1950 would be a formidable barrier to the markets unless we break out of it. Well, that's exactly what it was. And we can see that clearly. Now we're doing this. And on a perfect world, we would love this level to get tested that I keep on talking about in order to create another double bottom, which creates another very powerful bounce back to the same old level, 1950. Because if we break out over 1950, and where did things have happened in the market in the middle of all the doom and gloom, then this particular leg of the move comes into play, and we head back towards the 2080 level. Is it going to be one easy run? Absolutely not. And if what I'm seeing on the weekly charts and stuff that I'm going to show tonight, then I don't expect this to happen, because there has been a fundamental there has been a technical deconstruction on the weekly charts, which are showing that we are going to go lower over the following months. Things can change, but I'm just telling you what I see. I'll show that on the weekly charts. Now, when I look at the daily here, you're going to see that we are oversold, no question about it. You can see that. But we're not as oversold as we were back at levels where we get these very sizable bounces, this reversal candle and then the follow through. Now, one other thing that I noticed is I'm sure some of you are aware of this, called a day count. The number of days, and if you want to do exact pattern symmetry, it has to be the same number of days that we're down. So if you do a day count here, and we take this as the first day of the reversal, so that's 1, 2, 3, 4, 5, 6, 7, 8. On the 9th day, the fat lady sung, right? Right there. And notice also that on the 9th day, we had a beautiful reversal hammer. This particular one here, you can see that, which looked like we were going to break out. There was no indication whatsoever other than the fact that we were pretty overbought on the internals, just looking at pure stochastics, that we're going to. But if you look at this pattern, there was no way of that. This is it. This is a very nice reversal hammer, and it was going to break up. But this is the nature of global volatility as we speak. All of a sudden, the world changed. So look at this. And then you had a huge reversal hammer, looked like everything was going to go up, and then bang, bang, down. That's just the way it is, you know? So let's do the day count here, 8th day, 9th day. So let's take this as day number 1, this one here. 1, 2, 3, 4, 5, 6, 7, 8. Is it possible that we get a test of the 1800 level Wednesday and Thursday, and then on Friday they jam the shorts hard going into Valentine's Day weekend? It is. And I've gone through this stuff, and some of you were with me where I've been so dead right on these type of predictions that all I heard in the chat room was, whoa, man, that was fantastic. Well, it's just experience. There are no guarantees. Trading is a game of probabilities, not a game of certainty. So is it possible that on the 8th day, always has to be the number 8, right? That we create a significant tradable bottom? Yes, it is possible. Now, looking at this candle here, this is a doji, right? Right there. Some of you might be better candle readers than I am and stuff, but I just know it from intuition and from my interaction with the market on a daily basis. So this doji basically means indecision. Now it looks different when you look at the E-minis, but at least on the S&P 500 on the daily, it's telling you this doji where the box is in the middle, it's a sign of indecision, which means it can go higher or it can go lower. So we don't know yet. So that's it. On the daily, you got the lower Darvas at 1812 and 1792 as the lower Bollinger. Does it have to always touch the lower Bollinger? No. If it does, beautiful. Those are fantastic buying opportunities. Is it possible that the market has created a bottom at 1825 and wants to make a sharp move towards testing the mid Bollinger here at 1895? Even a move up to 1873 is good for 120 points on the Dow, right? Roughly around there. Yeah, absolutely. Is it possible that this is a dragon bullish formation in creation right now from what we saw? That's a dragon bullish, right? Just a regular W. Simple. Double bottom, move up. Is it possible that that's what's going on right now? Very possible. We don't know yet. We'll find out. All right. So that's the daily chart on the S&P 500. Now keep in mind we are definitively oversold. There's no question about it. On the market, these are the downward sloping 50, 34 day lines. People who've been with me, you guys know that. We have the standard deviation was very large from this point to there when we sold off to 1812. That was almost like a standard deviation of -9 or so, right? From here to there. And you deviate that much, you have a mean reversion. We did have a mean reversion right there. It almost came close to kissing the 34-day moving average. So mean reversion did happen. Now we sold off again. However, if you notice, and this is just noticing the way I look at things, is the standard deviation was huge here, just the way it was here. So a bounce was inevitable. But the standard deviation from the 34, which is this line here, to where we are right now, isn't that much. It's just this much. It's probably a -2. So as the moving averages, because of the thumping down every day, are sloping downwards, it doesn't take much to bounce and fail again. Remember, these are formidable lines of resistance in the form of large supply and sellers at those levels. So if the market, so that's why the market gets close to the 34 and sells off. The last time we saw something like this was here. We broke down. Every time it hit the 34 and the 50, it hit the 30, it fell, and then it finally broke through. If I see this market breaking through over, let's say 1945, 1950, which I said before, over the 34, you got to get really aggressively bullish, because at that point, the thrust and the momentum will take the market over the 50. All of a sudden, you hear the talking heads and all the traditional technical analysts on the media and stock twits and other forums like, oh, the market's changed direction, it's changed character, and all that garbage that you keep on hearing about. But the thrust will move it higher towards the upper Bollinger and all kinds of different stuff that we look at. So, but we are far from that at this point. So we got to keep that in mind. But I think that there is a good possibility that that happens in the latter part of February if there are signs of stability and you don't have major global banks blowing up like Deutsche Bank and stuff. So that's it. Now, if we look at the same chart here, and we look at this is the same chart, except this is the guts of the market, right? The futures markets, where the gamblers reside. This is the Vegas, the Wild West. So when you look at the oops, sorry. My apologies. Come on. Daily. All right. So when you look at this, there's no doji. There's no indecision, nothing. This is telling you straight out, looking at even the automatic, MACD crossover arrows and all that stuff that generated by Thinkorswim, not by me, this one, that it wants to head down and head down towards 1804 or 1805 on the E-minis. I mean, this is pretty clear. This is pretty clear. I drew a channel right there, and this channel intersects down here too. Now, I wish I knew exactly, which I would love it, that the market was going to come and test the 1810 level, and you got 32 E-mini points, roughly about 38 S&P points to take home. God, that's fantastic. That's about 300-400% on those S&P calls. I mean puts. So, but we don't know because of the random volatility that we're going through. So even though it looks like a confirmed breakdown down towards these levels, in a perfect world, it is definitively not confirmed, because there are levels of support at these levels here. You have to look carefully right there from the 24th or so of January that that it can hold and create a double bottom right there. There is no guarantee that it's going to slip below that and get down here. So that's the stuff that we got to deal with. Now, the other thing that I keep on showing, and you guys, some of you guys who really follow the charts know, is this channel here. I talked about the fact that this was possibly a bear flag. If you look at my charts from last week or so, I said, I put bear flag down here, and is it a bear flag? Well, it turned out it was a bear flag, because this, and if you know what a bear flag is, you know very well the bear flag is basically a lot of short covering, people getting sucked in because they think that the worst is over, and then they get slammed. And that's a bear flag. So this is a bear flag. So unless we attack and enter this channel over 1934 or so on the E-minis, then at that point we'll pick up the momentum to run towards that 1970 2000 level. That's where you're going to see things really move. Banks come back strong, the energy stocks come back, the tech stocks doing their wild 30-point moves, but that's only if we entered this channel, and we are far from it. Can it happen? Absolutely. Absolutely. Here's your downtrend line at around 1900 on the E-minis. So once you take that out, this downtrend line I'm talking about, this thick red line, once you take that out, there's a good shot that we attack 1932. Now here is the thing to keep in mind here, and a lot of people don't realize that just to get here is almost 100 S&P points. Ladies and gentlemen, 100 S&P points, you're talking about a 600 point plus rally on the Dow. So you're talking about the Dow heading back towards the high 16,000s towards 17,000. That's a lot of money. And they're not going to make that easy. You don't get from here to here unless something pretty dramatically changes in the sentiment and the risk-off nature of the markets that we're going through. Maybe a $2 or $3 rally in oil can do it. Maybe the Saudis come out and say, hey, we're cutting output. Maybe a bunch of the cartel get together at El Chapo's mansion in the jungles and say, hey, listen, guys, we got to cut some oil because our economies are really going down the tube. And oil jumps $5, $6. It can happen, believe me. And the market could have a 400 to 600 point rally in a space of 24 to 48 hours. We've seen that. We saw that here. So keep that in mind, that the lower we fall or we stay at these levels, the more the opportunity we have to bounce towards these levels. And those are big chunky moves. You're not talking about 50 point moves. We're talking 2, 3, 4, 500, 600 points. Just to move from here to here is roughly 500 points. Because that's 90 from there to there. Well, let's say from where we stopped today. That's 90 S&P points. You're talking about 500. Yeah, you're talking about 500 plus Dow points. That's a lot. So the downside, in my opinion, worst case scenario, remains at 1765 or so in the E-minis. That shows at about 1770, 1780 on the S&P 500 and this level. Because once we start moving towards here, and if we break that, there's going to be pure panic. And at that point, the move here will be rapid. And then boom. You just got to, in my opinion, you just got to buy blind and hold for. Remember, the best money is made in 24 to 48 hours. This is a humongous bounce like we had here, this reversal candle. So before I move out of this frame here, here is the close-up picture. You get a reversal candle like this, which we caught, that's huge. Doesn't matter what happens the next day, it is going to continue for at least 72 hours. We don't have that type of reversal candle yet. All these candles are dojis. They are all indecision. And that's why I don't get excited at the end of the day just because you got a rally. I've explained in my previous video cast, and please, many of you have listened to it, that a significant amount of sovereign wealth funds and hedge funds are using S&P mini futures to pay their bills. What does that mean? It simply means they're playing the futures pump and dump. All right, pump it up, sell it, take the cash, pay down the margin calls. It's like the best way, best scam in the world, but that's just the way it works. And that's why you see such massive volatility in the futures markets. A lot of foreign large players pushing up futures, and then it's free money. Amazon goes up $30, $15. Priceline goes up $22. Just name, Google goes up $30. That's free money. Bang, they sell it, take the money, pay down the margin calls. The margin clerks are waiting for that cash. So they're using the S&P mini futures as pure currency to pay their bills at the cost of the American investor. That's just the way it is, right? So we gotta be careful about that. Now, futures right now are down about 8 points. They were up about 8 points before I went and took a quick nap. And I can't tell you where the markets are going to open tomorrow because it all depends on Europe. They might have a big reversal rally. Asia is mostly closed because of the Chinese New Year. So we'll see in the morning. One thing do keep in mind, and this I noticed, is the pinch. Somebody said can't see your mouse cursor unless you draw on the chart. Can somebody tell me what that means? You can't see this cursor.
Hey Frank, it's Funky. Yeah, I was saying earlier I couldn't see your mouse cursor, but now I can see it. It's all good.
Okay. Good, man. I appreciate you mentioning that because I want everyone to be on the same page. All right. The other thing that I look at, and Richard, you're new, so I'm just mentioning this to you. I'm not a traditional TA, technical analyst. Okay, I do a lot of funky stuff. No funky intended on that side, but
Thanks
it
for the
works.
shout out.
I know, but Richard, it works. Okay, and that's my trademark. So so one of the things that I look at is look at what's going on here. This bottleneck looks like a little dolphin. Look at what's going on. Now, most of you know that when you get a bottleneck like that on the Bollingers, there's a big outsized move coming within the next 24 hours. Question is, which way? Looking at the candles, blindly saying, okay, look at this candle structures and what's going on, it's pretty obvious that we're going to enter this zone real fast. It's not much. It's only 36 S&P points. You're talking about roughly about 200 points. We can get that in 5 minutes. So that's one outsized move. Or we fall down here, which would feel pretty ugly for a lot of people who are heavily long on the long side. Because then it's going to be random selling across the board. This capitulative type of selling, which sets up a nice, beautiful floor for a bounce. So that's one move. The second is that it's going to break out and move, and it's going to move fast and furious towards here. So if you have to take, if we have to take a clueless bet, not an educated one, I don't think any real educated person should ever be traded. I'm just kidding. The thing is, if you look at the shape of what's going on here, I believe that we possibly come test the 1800s again, and then we make a sharp bounce, real sharp bounce, and head towards that 1900 level real fast, like 100 S&P points. You're talking about a 600-point rally over 48 hours. That's my gut feeling. Now, saying all that, the tighter the Bollingers get, the more confusing. This is how tight the Bollinger is right now, right? Right there. So this bottleneck does what it does. Now remember, it can do both ways. It can do a move up and a move down simultaneously, back to back, within a matter of 24 to 48 hours. So it doesn't have to be either or. Just want you guys to be aware of that. So you can understand the probabilities of what can happen. But a tight Bollinger, like we're seeing here, is signifying an outsized move coming, which kind of fits in with with the Janet Yellen testimony, right? So let's be really on our toes when that stuff is happening. One other thing that I always remind people, because I get this question all the time, well, what's going to happen? Well, whatever happens at a Janet Yellen testimony is just the same thing that happens with Fed announcements, Fed rate hike announcements, rate announcements. You get a three-wave move, and they are violent and fast and furious. You get you get three waves. You either get a wave up, then you get a wave down, and then you get a wave up. Now, depending on whether it's a wave up or down, we don't know. But generally, the first wave equals wave one equals wave three. That's right post testimony. Now, here's the thing here. The testimony is going to be released earlier. They release the papers, right? So you can read the speech. So and CNBC and Bloomberg are going to be all over it tomorrow. And she's starting to speak at 10, I believe. Then this is wild, because right by 9:30, right as the market opens, we're going to start to see the big moves come through in the market, because it's her prepared testimony. Her prepared testimony will talk about what she's going to talk about. But I think the real action will come when she starts getting grilled on some of the more sensitive topics, such as negative interest rates and stuff like that, by the House panel. That's when you're going to start to see some real moves. But the prepared testimony is going to be first thing in the morning, right off the bat. So just remember that. So anyway, and I wouldn't be surprised one bit that after there's going to be at least one move down, in my opinion. Or it could be that it's just a one-way runaway train where the market just says enough is enough. We already know she's not going to do anything bad. That the market basically just makes a big move up to 1932. I mean, heads towards that level, at least 1900. I mean, that's going to be first level of resistance. So a 200 to 300 move right off the bat in the morning is also likely, because the prepared testimony could be very favorable to the markets. Now, I'm not going to sit here and analyze everything she's going to what she's going to say and stuff, but I bet you she's not going to harp too much about the fact about global instability. She's going to mention it, but she's not going to harp on it. And she's certainly not going to say that the U.S. economy is falling off track. So don't expect to hear that stuff from her. So that's it. So that's what I expect tomorrow. This is the range we're going to follow. We are either going to head towards that 1880 level, 1900, but it like I said, it's going to be both ways. It's going to be, what would be a perfect scenario is we come test this and then make a beautiful move up. That would satisfy both the longs and the shorts, and they would expect to see some very large shorts covering at this level, which correlates with this. So it's pretty simple to see. That's the scenario for tomorrow. Now, let me show you one of the most successful trading that's occurred over the last couple of weeks, if not the last couple of days, on DWTI, on the oil trade. And I think people who participated in it should really commend themselves for tracking the charts that I put across and understanding what's going on. This is not a crazy trade. These are systematic, structured trades that anybody can do. And people who are not doing it, honest to God, you got to really get your head checked. Now, I'm not asking you to go out there and buy 200-300 shares and every 2 seconds be down $1,000 or up $1,000, because that's what the DWTI does, right? It moves in moves of $4 to $5, depending whether oil is moving up 2 to 5 cents back and forth. So it is truly volatile, but the charts have been put in place for the benefit of everyone for weeks now. So I'm not going to sit here and basically yell at people because they haven't done it and stuff. But I think I don't need to yell at anyone, because the people who didn't do it, they're feeling like crap. Because I called this shot at 220, and on a staggered basis, almost every day, played it back and forth, and it went to 380 exactly as I showed. And anyone with a keen eye could see that this gap here, and I have multiple charts on that. I always put it as DWTI oil trade setups. I'm sure you guys have seen that. I put this chart up there. I mean, nothing can be more, what's the word I'm looking for? I mean, it couldn't be any easier than the way I put it across to people. So you could play with a couple of shares. If you get 200 points, let's say you said, I'm going to buy 10 shares and I'm going to just leave it in there. And you got 200 points on that. That's $2,000. And the fact that so many people didn't even do it, I don't need to tell them because they already feel like crap anyway. So, what can I say? Now, we started playing this from these levels, the 200 to 223 level. All that posted on the Twitter feed. And this is, it was a very structured move based on what oil was doing. It's choppy. Every one of these candles are worth about $5, but you can see the pattern symmetry on this very, very clearly. Now, if the smaller the number of dollars that you play with, remember, small gets big in the form of playing these DWTI type of ultra derivative trades. So you don't need to, like I said, the larger the dollars that you put in there, this is behavioral finance, the more you're going to screw up. Because what's going to happen is either you're going to sell early or you're going to flip out because it's down $5 in 2 minutes for no other reason that oil had a little 20-cent bounce. So you need to play with small to moderate amounts so you have the mental ability to hold on to that swing trade instead of putting in 500 shares thinking you're going to make $10,000 in 10 minutes, except you get stopped out with a loss of $2,500. And that's just reality of anything, but more so in the reality of derivative type of trades, which move at light speed both ways. So very just a simple suggestion. So saying all that, this was called on. We bought it again at these levels, staggered up. In hindsight, it looks beautiful. Like, oh, wow, it's 220, definitively going to 380. I didn't know it was going to go to 380. There were times that oil was starting to rally. And this thing fell one day from, just last Tuesday. Once we sold it around here, this thing fell from 340 down to 200, 140 points, because that was the time that oil rallied $3, if you remember. But back up on the high horse again. And this is where it went. This was the gap fill, and it filled the gap. And I showed that a zillion times. So now you know. Now, does that mean this trade over? No. Oil's chart looks like crap. And you're looking at this here on the side here. This is the daily chart. Yes, right now it looks like it found some sort of possible tradable bottom here at the 2756 level, which I showed before was they're going to test the lows. It came close to test. Yeah, it tested the lows right there today. That was the point that we exited DWI at around 380. And it closed at 357, 23 points lower. You can see that. But in no way, I don't think in any way it's over yet. So oil, if you look at it purely from a technical standpoint, the lower Bollinger is at 25.45. Is it possible that we get another set of really crappy numbers or a couple of other hedge funds blowing up? Or no OPEC deal whatsoever, because there are rumors out there that OPEC's finally getting together to hammer out some sort of output cut and move up the price, stabilize the price of oil. Is 25 doable? Well, technically speaking, yes. 25 is doable. If oil falls from 28 to, let's say, has another massive crash down to 25 over a couple of days, this thing, ladies and gentlemen, will go to $500. So the way I look at it is, if I've constantly shown this, so if imagine this was a stock and I didn't need to even spin a story, and I said, listen, you buy this stock at 200, looks like it's going to go to about 300 at least, or at least it's going to go to 250. and best case scenario, it's going to go to about 400. People will be losing it. Well, that's exactly what's going on with this baby. So sometimes, sometimes they wonder, like, why just treat it like it's a stock with a story, because oil is a story, and this is the best way to play it. Now, there's no, I've tried to short this, but there's never any shares to short. So I guess somebody must be really short DWI out there, or just took the whole float and said, you know what, I'm going to keep it in my book as a massive short, because one day oil's going to go up to $50 and this thing is going to go back to $100. It will happen. There are no shares to short on this, and there are no options. Thank God there are no options, because you'd be losing money right, left, and center every 2 seconds. So anyway, um, so that's this trade setup, I would say, is something that people should look at. And for people who want to test how to really trade a fast moving monster, like I half jokingly say, buy one share. So at least you understand the mechanics of how these things work. But this you can clearly see. I don't need to say anything. I mean, this is fantastic, and many of you did that. I even came in late. Sienna just walked in, and I said, "Hey, because I was tied up with work." So I said, "Take a look at this. It looks like it wants to go higher." I think he made another 20 points on that, 20, 25 points on it way after. And since yesterday's call, which I believe was somewhere in this range, you're talking about 75 points or so. It went up. So again, this is not a sort of, I'm not going over and over this, just to sort of, I'm just saying this to hammer down the point here. This is another exercise in glorifying myself. All right. So this is something you guys really need to look at when I put it out there. All right, let's see. What else we're going to look at? One other chart we're going to look at, then we can see, then we can take a look at, we can look at a few stocks, which I think are due for a severe oversold bounce. Some of them already started doing that, such as Priceline, the Googles of the world, Netflix. And those are worth noting for sizable bounces. Okay, so this is the trading view version of the market, and all these arrows that this chart is just as clear as daylight. Okay, we are starting to see there's a volatility cluster going on here. Look at the pattern symmetry. I mean, it's just fantastic. I mean, of course, I drew a lot of lines and stuff on it, excuse me, which put things in perspective. But it is starting to look like that there is a double bottom formation in the works, which is pretty clear. It doesn't mean we can't come and test these lows, as I explained on the other side, but it's this volatility cluster needs to break out over on the SPY over 187. Upper gap here on the SPY is 187.26. You can see that right there, 187.26 or so. So once it takes that out, all of a sudden this arrow moves up towards the 50-day moving average at 189.53, and you can keep on moving it up depending on how fast it's moving. But so far, it's starting to look like we should be in for a bounce shortly. Now, let me draw something here, and I've talked about this in the other charts many times, which is a bear flag. Oops, sorry. Bear with me. I think better way to look at the bear flag is what I had before. Okay, I put this chart up too many times today. So what you're starting to see here is, was it this one or the 1 hour? Hold on. Bingo. So you're seeing a lot of volatility at this level. This is what was at 3 p.m. when the news came out of the negative rates. Generally speaking, just so you know, that when you, this is known as a naked bar spinning top, where you have a let me get all these lines out. Remove all drawings. Okay, good. So when you get this, when you get a reversal candle like this, it's known as a naked bar spinning top. In simple terms, it simply means that it spikes high, really hard, went to 1863, and all of a sudden it's like that beep beep the roadrunner, right? Willie Coyote, he jumps off, runs off the cliff, all of a sudden realizes that nothing's around, and then boom, drops. That's exactly what happens. You get a big spike, then the buyers realize, oh boy, I'm just lying, I'm in midair, and big time selling comes in. So generally when you see that, some of you might be aware of this, you don't want to hang around town too long, okay? Because that accompanied by a large sell candle, almost 403,000 contracts right there. These are the E-minis. Now remember, the E-mini contracts are transparent, right? There's no E-minis trading in dark pools. So these are real volume that you're seeing. A lot of stocks, as you know, trade away from are not transparent. They're trading a lot away in dark pools and private exchanges and not being reported in public exchanges. So we don't know the real volume a lot of the times. But in the case of E-minis, they're clear. So there was a huge sell. Look at that, 400,000 contracts of this right off the bat here. So got to take that into account. Not to say that that can be negated next morning, but this has to be taken into account. So generally speaking, if this happens, unless this is taken out, which is 1863 or so, it will it's going to basically remain as a top 1860. Now 1843 to 1863, you're talking about 120 S&P point, Dow points before it gets there. But what I would like to see on a 1-hour chart, this is pure technical stuff, okay? Somebody need to mute the microphone. I'm hearing their family in the back. Can somebody mute the microphone in the back, please? Okay, don't worry about it. So bottom line is that what I would like to see, and I think one of the guys in CNBC mentioned that too, it's pretty obvious here, that if we take out 1865 or so, all bets on the short side are off, because at that point you're going to see a pretty powerful rally up towards the 1910 level, up towards here. So just keep that in mind. So, like I say, you always got to watch the futures. Very, very important. So once we take out roughly 1865, next stop will be 1880. Either we're going to be met with some heavy duty selling at this level, because that's exactly what happened here. This was the breakdown level, if you remember. So there's a lot of supply at that point. So either this pattern gets completed, and then we get another mini leg down, or if this is a cup, then we can create a handle. Doesn't have to be another crash. Cup and handles are always fine, and then we make a move up from that. But in order for that to happen, we got to take out the 1865 fast. Please watch it on your futures chart, big time. If we break below 1830, then short at will, all the way down to 1813. But it has to be a powerful break below 1830, not just a test and a reversal candle like we saw today at 12 noon. Fair enough? So that's, so these are key, because it doesn't matter what trades you're doing out there, if you're not watching the futures chart quickly on the side, you're going to either miss out on taking your profits, or you're just going to basically hate yourself because you didn't act fast enough to take the profits. Okay? But when the run starts up towards 1860 level, I am positive there's going to be some strong selling at the 1865, 1866 on the E-minis. But if we can take that out, it's going to be just a massive short squeeze, burst of new buyers, and you're going to make a beeline for the 1900 level. and it's going to be very fast, very furious. So don't sit around thinking, oh, I'm going to get another quick pullback and things like that. It's going to be a powerful move up. So this is the range that I'm looking at, where the market is trading. It's pretty clear. It's 1860 to 1830. 30 E-mini points, or let's call it 30 S&P points, that the market's trading in. It's about roughly 180 Dow points. So pretty much, that's where we are with the markets. But so let's take a look at a couple of quick stocks. This is before I forget, here's another quick representation, and this is actually a much clearer one. I like this a lot, of the Warden free stock charts. It's very clear. This is a bear flag. This is a bear flag right there. You had a reversal candle today actually right at the close. You can see that there. Doesn't mean much these days. It simply means that it can come down here towards 1846 and make it bounce. If they keep on climbing on this flag, let's say it keeps on doing this, let's say it comes down a little bit, makes another move, then you eventually get to about 1904 on the S&P 500. But if this channel breaks, as it did, it broke and it went straight back in. But if it breaks, and it breaks hard, then it's going to test 1832, and in reality, it should come down and test the 1820 level again. Yeah, test 1820 again before it bounces. We'll see what happens. The internals are starting to look positive. So anyway, these are all these different things that I watch, and what I put out there. You guys should see that too. Stocks, Google. All right, this was a long-term. This was a chart that I'd drawn way back, if you recall, prior to earnings and stuff. And I'll tell you, that's pretty much what it did. It didn't get up there to 840, but it did get up to 811. And if you know, we played the Google earnings on the long side. And so the point is that when you look at Google, right here, worst case scenario, another 20 points, lower Bollinger, 675. That can happen in 10 minutes. We know that. I'm not even looking at internals or anything. I'm just basically just simply looking at pure chart function. And a bounce up to test the downtrend line would be around 750. So Google's good for about, or testing the backside of the 34 and the 50-day moving average. So you're looking at roughly 750 to 760. First level of engagement. So risk reward favors the upside. You got a pretty significant double bottom. Unless it breaks down below the 680 level, in which case 620 comes into play. You can see that. These are very clear-cut levels you can see right there. I'm just keeping it simple. You have a fantastic double bottom dragon bullish formation. So little slippage is welcome. We also have a hollow candle reversal coupled with a bullish hammer right there. And this is something that has to be on your radar. Let me just get these lines out. There you go. So you had a hollow candle reversal that got rejected at the 5-day moving average right there, like clockwork at 719. Came down. The hollow candle remained intact. And every time you get a hollow candle, you get a very powerful move. The hollow candle has to come off some significant bottoms, just so you know that. You can't have a hollow candle right in the middle of nowhere like it was. This was a hollow candle in the middle of nowhere. It doesn't count. It has to come off a significant bottom or inflection point. So that inflection point is pretty much 686, 680 to 686. Slippage below is obviously, there. So this stock can be played on that reversal bounce that might be coming up to 750. Yeah, 746, 750. That's a lot of money, especially for options players. Or even if you buy, I mean, I buy a lot of common. You just buy common shares. I mean, I'm not saying you go out there and buy, huge amounts, but just imagine, you buy 100 shares. If it bumps 50 points, that's $5,000. It's not rocket science. Use margin power in a day trading account to do that. It's just not, this is not like some $2,000 stock. So best, in my opinion, one of the best ways to play it is, yeah, you can buy some cheap calls and stuff, but if they don't work out, then those calls get in trouble, is you buy 50, 100 shares of the stock and just sit with it and let it do the job. At least you can get stopped out. You don't get completely blown up. I mean, that's the way, in my opinion, in a volatile market like this, why bother scrambling for options like crazy because the premiums are getting sucked in and out because of the volatility? You can buy, like on smaller accounts, you can buy 10, 20 shares of something moves $20. You do a couple of them, $20 here, $10 here, $15 reversals, $30 reversals. All of a sudden, you got a P&L that's moving. So it's not rocket science here. You got to keep it simple. And people say, well, I don't have the ability to do that. Well, let's put it this way. You can buy 10 shares because if something moves $40, which it does from the bottom, that's $400 on one trade. So excuses a dime a dozen, I stopped giving myself excuses a long time ago. And all of you try to do the same thing with yourselves, Don't pull excuses. Like, just do what you need to do. Just make something. Even if you make $5, that's $5 you didn't have, right? So just the way I look at it. All right, let's take a look at Netflix. Netflix it's going to explode. I'm telling you right now, in my opinion. We got a worst case scenario in Netflix is basically the lower upper gap fill here at, which would be a beautiful buying opportunity at 76. So $10 from here. There's a lower gap here at 70. Is it possible? Anything's possible in this market. So, not going to write this out. But looking at the formation on the daily, this is a macro falling wedge with a formation in there just waiting to burst out. And if you notice, Netflix was the first stock that went green and stayed green, went back slightly in the red, moved back solidly, up 4.5% today. I don't see many things up 4.5%. It was the biggest mover on the large cap on the Nasdaq 100. It was up 4.5% plus today. So this breaks out. There is nothing to stop it on a swing trade, mind you, to get to test this large downtrend line at 102. Of course, it's going to find sellers at right there at 97. Right there is a lot of supply, a lot of selling. It's going to find sellers at possibly 90. Right there. But on a swing trade, as the market basically, breeds out and heads towards that 1880, let's say 1900 level that we showed earlier, this stock can get to 102. And that also, the engagement with the downward sloping 50 and the 34-day moving average comes in at play at around 100. So right there, you have it. And there again, I'm not going to get into the fundamentals and all that, stuff. I'm just telling you like what I see on this particular move that might come. Let's take a look at Amazon. Amazon's chart is a little bit more complicated because Amazon broke down hard. So at this point, there's a couple of things here that I'm looking at. One second. And I'm showing you the big, 10, 20, 30 point type of movers. Let's see. So you got 450 would be fantastic. It's right there. That was a major breakout level for Amazon. Multi-year breakout level, right? 450 right there. It's getting close to it. Can it get there? It sure can. We have two dojis, semi-hollow candle type of things hanging in midair. So it's possible that it pulls back here and then makes a nice move. So this would be the remember, stock was breaking down big time back in October of I'm sorry, back in August of 2015, right during the previous crash, the flash crash, and it looked like it was going to completely break down, but lo and behold, it just turned around and just ran. And we noticed it because this was the cup breakout, multi-year breakout at this level, and that's exactly where it held. So it looks like it's kind of doing the same thing, but it could possibly turn from here, which is right there. So if Amazon moves, you're looking at roughly 60 points, somewhere around 540 would be where it gets to, or it could get to 1 second, somewhere around 540 to 580. So that's another one to keep in mind. So these things, the fund managers love these stocks. Okay, they lots of powerful selling. The stock's down from $700 to 482. It's due for a bounce. Not looking at the long-term picture or anything, just telling you from a tactical perspective what might happen. Price line looks like it disappeared. Where is price line? Oops, this froze. Bear with me. We can just look in this. Okay, came back. So here's price line. I put it out there. I also had a price line trade from earlier that worked out very well. Airlines were very strong today. Spirit Airlines was up 7.5%, 2.5% for American Airlines. Sabre, the Sabre Corp, that's the ticketing software, the software management company for the airlines, was up 7.5% on days like today. So obviously Priceline was a big beneficiary of that. So channels are very clear, and you can see the stock basically can get up to 1040. So you're talking about 40 points here, right? 937, yeah, about 45 points. It gets to the top of the mid channel. You're looking at 1073. That's how the stock is trading. You can clearly see that right there. And let's say somebody says price line, it's going to go down a lot lower. Well, okay. So if it's following the channel, this is what it's going to keep on doing, right? Keep on going lower. But in the meantime, you got a sizable bounce on the stock that I believe a nice bottom on the stock was created today at around 950 or so. Let me just start wrapping up. Hold on. Tesla, it's just, I was doing this earlier on. This is what I'm looking at Tesla. Obviously, Solar City is a direct impact on on Tesla. So looking at this here, Tesla could honestly be a short all the way down to 116. Just looking at it purely from a chart standpoint, right there. This was a major inflection point for the stock at 115, and for the stock to lose another $30 is not asking, is not like end of the world. You could possibly find some support at 137, or the stock could just turn around and run because Tesla is Tesla. So, but this is a really crappy looking chart, which looks like it wants to resolve itself on the lower channel at 124, if not at 117. The problem is that when you short these things hard, it tends to just go around and just kill the shorts. So now that it's a weak market, I'm sure the shorts are going to press on it. Also, given the devastation in Solar City, Tesla's going to come under some pressure. Facebook looks like it's got a little bit further to go down. I think Facebook would be a great buy somewhere around the 92 level. There is a hollow candle reversal at this point, so it could very well keep its move here. But if you look at this chart here, it's lost to 34, it's lost to 50. It's given back everything from 120 when it was looking just fantastic. So LinkedIn didn't help either. So 93 would be a good level. Just pure channel work. Look at that. That's on the daily. Apple, believe it or not, is in pretty damn good shape. And that's why even on rough days, it wants to go green. So looking at Apple here on the daily, this was the channel that I'd drawn weeks and weeks ago, and it's holding this channel fine. So it could still come down and test 91, but my gut tells me that the stock is going to hold this 91 level pretty good. Or if it all bets are off if it goes below the August 24th level, which was 92. So if we break below 92 with some sizable volume, the next level comes in. I don't even know where the next level comes in, to be honest with you. Let me see here. The next level comes in at this large cup breakout at around 83. If we take out the 91, 92 level, the next level would be the next level of engagement is going to be around 85. Sorry, 85, right there, 85. Okay, 85 bucks. But Apple looks pretty washed out, and this stock could do. Let me take all these drawings out. Hold on. There you go. This was the massive multi-year cup breakout. So it's gone below that now, and it's a pretty defined chart actually, right there. There you go, 93, and the next would be right here, points, 84 to 85. So there's your chart on Apple. Best case scenario, buy it at 85, or it makes a pretty sizable bounce from here, and it could very easily get up to the 105, 107 level, because that was the breakdown level right here, 108. So get ready for this. All this stuff is going to happen. I'm just letting you know. Okay, all this stuff is going to happen. So I'm just preparing you guys that just keep all these on your radar screen, because, like I said, if this market's really going to have, we're going to go into a bear market, then the bear markets don't start off from these levels. They have powerful rallies. They suck people in. People start to feel comfortable again, and then bang, they crash. So that's what bear markets do. Bear markets have very vicious rallies. Same thing happened in 2000. Same thing happened, in other years before things went crazy. So just keep that in mind. So all I'm showing you are retracement levels where these stocks might go to. Any quick questions before I wrap up? Anyone?
I have a question. This is Richard. Can you talk about the Valentine's Day related move earlier? I didn't really understand that.
Yeah, it's very simple theory, which I've noticed over the years, is when you get a huge shopping weekend, because it is a pretty significant shopping weekend, okay? You tend markets not to have sizable moves down prior to that, whether it be Columbus Day weekend, whether it be Thanksgiving, whether it be any major holiday. There's a very simple reason behind it, okay? And I'm making it simple, but it's worked every single time. More than 70% of the US GDP is consumer spending. And for whatever reason, the hidden forces that are within the market, don't have sizable crashes before big shopping weekends, and Valentine's Day is certainly one of them. So when you get these type of, it's almost like a psychological thing. Not to say that you're going to have a 700-point rally prior to Valentine's weekend. I'm just simply saying that don't expect, unless, anything can go wrong. This is a crazy market. I mean, this is a market dominated by global pressures that we are not accustomed to. So generally speaking, that's the theory behind not shorting large significant holiday weekends. And I'm saying this because it's worked pretty much every single time. I warned people before on these type of things, and so that's the reasoning behind it, Richard. Any other questions? Oh, just one last thing here, Richard.
Yeah.
Any other questions?
No, I'm good, thanks.
Okay, one other quick thing here. When I look at the UVXY, right, this is why it's such mixed signals in the market. When you look at this UVXY, this is not telling me it's over, okay? Because neither is it overbought. This is on the daily. Neither is it overbought. It's bumping against a level that it can easily break through, which is a 55 level, and hit the cluster zone, which I consider to be formidable resistance, which is 65. So if my theory pans out that the market wants to take that and retest the bottom at 1804, 1780, 1790, thereabouts, you're going to see 65 on the UVXY in a flash. So this, when you look at this chart, it is a constructive, it wants to break out. It is just dying to just take out. And unless we see a large reversal candle, this has worked for me every single time. Unless you see a large breakdown reversal candle of this magnitude, that confirms a downtrend on the UVXY and the inverse proxies, and tells me that the market is on a short-term upswing. And I've identified these in my previous charts, and people know that very well, that I've called these very well. So I am not ready to, I haven't seen it. And looking at the internals, basic internals, it's not telling me anything either. Yes, it's overbought, no question about it. It simply means that it can come down to about 45 or come down like it did yesterday. And I said the sell-off's not over. Come down to 48, hold this gap. Remember, this was a gap from, back here from October 2015. So this uptrend line here on the UVXY, this channel, I should say, is what I'm looking at. If we break below the channel, below 44, by that time you'll see one of these ugly red candles. You can pretty much say, okay, you can swing longs for a bunch of days instead of having to take everything out every 2 hours. So the UVXY is not showing me that the market's ready for it. It can happen tomorrow. We could get one of these very large sell-off candles, and doesn't matter if it bounces up. And once you have one of these, that means there's a lot of selling that went in there, and it is going to reverse down a bit. What does reverse down mean? Simply means that it comes down and retests the 39.40 level, and it'll bounce from here again. Because these lines are telling me that the UVXY, that it's still on an uptrend. Unless these lines curl down like it did here, it's not some sort of long-term breakdown. It simply means a corrective pullback down here towards 40. The same thing I saw with the VIX. Looks like the VIX wants to get up and try to attack the 30 level, the downtrend line, all the way from from the 52 from August. So it can easily do that, and if it breaks it, expect to see the VIX jump up to 35 real fast. And that's when you get those plunging, 1800, 1790 S&P type of deal. Yeah, so that's it. All right, guys, ladies and gentlemen, any other quick questions I can answer?
Hey, Frank, this is Corey. I got a quick question.
Go ahead.
Is most of your short-term book short right now, or are you just neutral?
No, not most of my short-term book is. I just have a bunch of S&P puts. So I have a mixed bag, but my long-term trading positions are minimal right now. So that's the,
Okay, thanks.
yeah. So my long-term trading position minimal, that's clear in all my comments. I do not want to be overnight long big number of contracts on Priceline and Netflix and all that stuff. It's just, I do not want to be, for reasons that I explained very clearly today. So yes, I have the net bias is on the short side right now, but they're all tactical shorts, which I might even take a loss tomorrow. You know, waking up tomorrow morning, futures could be up 30 points, but it doesn't matter. I'm following my charts, and as long as those levels don't break out, I'm going to stick to it, add to it, and remember one thing: just when you start to think that everything looks okay or everything looks terrible is exactly when it goes the opposite way. Now, that's psychological stuff you guys do. I look at it from a purely tactical chart standpoint, and I you know, and I tried to explain that as clear as possible tonight. And of course, all the charts that go out during the day, you guys can see it too. If we, you know, I'm watching these levels, and if these levels are not breached to the upside in any significant way, then at least on that particular side of the book, which is a tactical short, thinking that the market might retest 1800 levels, will remain intact.
Thank you.
Yeah, not a problem. Anyone else? Okay, guys. So in that case, thanks for attending. It's 10 o'clock, so I'll tell you, it's gonna be one heck of a day tomorrow, for sure. But
Thanks, Frank.
yeah, but I think I've explained both sides, so let's be prepared for that anytime. And please go spread the word. Richard, thank you for testing us out. I'm sure you like everyone here. It's a fantastic group of people, and it's great to have everyone in there going back and forth. So appreciate it. Okay.
Thanks, Clue.
Anytime, Regem. Feel better. Okay. I know you're
Thank
a little bit under the weather. So, all right.
Yes.
Okay. So we'll talk to you guys soon. We'll see you guys tomorrow. Thank you for listening.
Bye.
Bye.
Thanks.